Hi, and welcome back to Tim Bigham's Options and Volatility Newsletter, a UOA Today edition, unusual option activity, where we highlight trade opportunities based on unusual option activity, out of the ordinary option purchases that dwarf the open interest and in a jump implied volatility, i.e. the price of the options higher. So we actually have 5 different vol capture trade ideas based on the unusual option activity, especially on the call side in energy fuels. A big uranium producer, uranium related stock. So let's jump in and take a look at things. First of all, here's one of the scanners I use. Here's UUUU from Friday. You can see almost 350,000 options traded, right, which is dwarfing the average volume of under 60,000, almost 6 times the normal volume. So certainly a hallmark of unusual option activity. You can also see implied volatility jumped higher, right? It's at 100%, so IV still hanging in there. Although weakening slightly, we did see it to actually hit the list the prior 2 days. We don't like to jump necessarily in front of the trade, but once either volume or IV starts to level off, then we'll jump in and take advantage of it. So in this case, we saw still heavy volume, right, but IV start to level off. Here you can see IV elevated at 100% based on their metrics there. You can see on the chart, here's that huge spike in IV, and then finally a little bit of a give back. So that led us to jump in to these trade ideas, taking a look at it from a different perspective, right? Here's all that option volume based on the different expirations. I highlighted the upcoming weeks expiration simply because a couple of our trades we're going to stay very short term because it does have earnings coming out the following week on November 4th. But here you can see that IV just leap as it was trading right around the 100 level, crept higher, crept a little bit higher, and then exploded over the past 3 trading days. We saw increased volume on that, so we saw this kind of pop and drop, and then a rip higher here. Here you can see that it's trading on a slightly different metric at the 95th percentile. Calls far outpacing puts as well. And you can also see that the call IV has exploded higher too. Out of the money calls trading at a huge premium to out of the money puts. Now you can see going back, the calls carried a little bit of premium, right? But then over the past 3 days, we saw this huge explosion, and we saw that skew steep into the call side, even with IV dropping a little bit on Friday. Another reason to jump in to a couple of the trades. And as I said, earnings coming out November 4th, Tuesday, right before the bell. So that's set up ideally for a couple trades that follow that bullish call buying, right? A bullish lane, a couple that are defined risk that are more neutral in nature, and then a couple that have, a little more risk to them, but you're able to capture more implied volatility simply because you're not buying that hedge. So let's jump in and take a look. First, a simple covered call trade. So I pulled off option montage going back to October 20th, basically to start the week. Stock was at 22.58, and going out to December, because covered calls usually like to go a little bit longer, in my opinion. The December 25 call trading right at $4, as you can see here. So the buy right, which would be to buy the stock, sell that call for protection, right, to reduce your initial cost, right? You're giving up the upside above 25, right? But you're defraying the cost by $4. Very nice on a $22.50 stock, right? So that buy right would cost $18.58, right? Again, buying stock at $22.58, selling that call, and the IV on that call at the time just under 140. Fast forward to Friday's close, we see the stock closed at 21.37, so it dropped $1.21 from basically the start of the week, right? But we saw the December 25 call actually go up in price by 55 cents, right? It was closing at 4 with the stock at 22.58 to start the week. To end the week, the stock dropped, but the call went up dramatically. Why? Because we saw this huge jump in implied volatility due to all that option buying, all that unrelenting call buying. So the buy right, buying the stock, selling the call, got dramatically cheaper. You're able to buy the stock at under 21.50, over $1 cheaper, right? And sell the call at over 50 cents more expensive. So you're able to get the best of both worlds than where it was to start the week. You were able to buy the stock 22.58, so that D's 25 call at 4. The stock dropped and the calls went up, sets up ideally for that buy right, get in much cheaper, and all that because that huge jump of over 30 vol points in IV. So you can absolutely lower your downside risk, lower your initial cost, right? Increase your potential return, right? If the stock closes at 25 or higher, right, and gets taken away, you're doing a much better job as far as the return on the trade as well. So certainly a covered call, simple way to do it. Any option account is approved for covered call buying. Another kind of defined risk bullish trade, right, is a put spread, a bullish put credit spread, right? So selling a slightly out of the money put spread. Took a look from October 22nd here. The stock was at 20.63. The October 2017 and a half put spread that expires next Friday, right? So we have a week to go on it. A little bit more back then when I did this comparative. Trading right around $1. The IV on that 20 put a little over 150, and it was 63 cents out of the money. Right, stock was at 20.63. That 20 strike put 63 cents below the current stock price. And if you were able to sell that 2017 and a half put spread for $1, right, bring in $1, risk $1.50, right, 2.5 point wide spread, but you're bringing in $1 net credit, so your actual risk is $1.50. Your return, if it expired worthless, 66 2/3%. Fast forward to Friday, you can see the stock rallied from October 22nd, right? So we had the stock going up from that comparative day, 74 cents, but the put spread actually got more expensive, right? The put spread went up to $1.12 from the previous dollar. So you have the stock higher, the put spread getting more expensive, which makes no sense. And you have some time decay, right, on this as well. Certainly time decay, especially because this is expiring this Friday, right? Every day becomes more important as you near expiration. But that put spread actually got more expensive. Why? Saw a massive jump in the implied volatility, right, of almost 70 vol points. So it's out of the money now with the stock at 21.37. That 2017 and a half put spread out of the money by $1.37. So a much bigger cushion, right, of 74 cents. Yet you're getting a bigger net credit on the trade. You increase your return now to over 80%, right, since you're risking $1.38 to make $1.12. So a very nice risk return on this basis as well. So that's another way to lean bullishly with that predominantly call buying, repeat call buying out there in UUUU. Certainly this one makes a lot of sense as well. You can, define your risk, put on the trade, and hopefully set it and forget it. Another defined risk trade is an iron condor, and that's simply selling both the put spread and the call spread at the same time. More neutral trade, right? So it's a way to capture vol on both sides. So again, went back to that over October 22nd date, stock at 20.63, right? That iron condor, which in this time we moved the put strike down and tightened up the spread. So we're selling the 26.28 call spread, the 19.17 put spread. So a 2-point wide spread, max risk, $200 per spread, right? You're able to get 72 cents with the stock at 20.63 on October 22nd, right? The put was out of the money by $1.63, simply because 20.63 less the $19 strike price in this case. The call, that $26 call, out of the money by a much bigger degree, right? 5.37. So certainly favoring a little bit of a bullish lean to this trade, right? The IV on the put at 147, the IV on the call at 167. So if you're able to sell that iron condor at 72 cents, you'd have $1.28 of risk, right? 2-point wide spread at max risk, bring in 72. Your net potential return, if both sides were expiring worthless, if UUUU closes above 19 but below 26 come this upcoming Friday, you'd make over 56% net return. Fast forward to Friday, right? We see the stock close, as we said, at 21.37. Goes to a more ideal spot, right? The put is now out of the money by 237, so a little, much of an uptick gives it a little more cushion on the put side. The call still very much out of the money by 463, but that iron condor jumped in price, right, from 72 cents to 95 cents. Why? Because we saw this huge jump in implied volatility, and especially on the call side, as we noted, that call off just going off the charts here, right? So 291 IV back there, it was a 167, so a massive jump in implied volatility, right? So you have still a very nice cushion on the call side of over 4.5 points. The put side, a bigger cushion, right? You have less time to expiration, right? You've had, 3 trading days peel off as well. But your return now, if it finishes above 19, below 26, is over 90%, right? Able to sell it at 95 cents, risk only $1.05. So certainly that iron condor trade with that huge jump in both the put and call IV sets up nicely for a defined risk vol capture trade. You're only risking, basically $1.05 to make 95 cents. So a 50-50 trade-off that you don't see UUUU move huge any direction in the upcoming week. For those who like to maybe play it a little riskier or lower your position size, right, and capture just pure vol, we see the October Strangle, right? Same sort of idea here. So went back to a week ago from Friday, stock at 2106, selling the 20 put that expires October 31st, right? And the 25 call, selling the Strangle, would have brought in a little bit over $3. The delta on the trade, right? You're selling a 37 delta put, negative, right? So that's plus 37 deltas, selling a 34 delta call. You'd be slightly long, 3 deltas net long. The IV combining the average, if you will, of the put and call right around 152. Fast forward to Friday, right? The stock, fast forward, to October 22nd, stock at, as we said, 2063. You can see that Strangle dropped in price, which you'd expect, right? Because the put is becoming closer to going in the money, right? So you would think that would be a negative kind of for that Strangle, right? You can see the delta on the trade is now 11. That increase, right, simply because that puts a little bit closer to the money. And the IV did pop up to $1.65. Fast forward to Friday, we see the stock returning pretty much to where it was kind of to start the process here at 21.37. So comparing it to the original at 21.06, the stock is up 31 cents. You have some time certainly coming off the board, and with this one being short term, certainly a meaningful thing. But you see that Strangle now exploding to $3.60, or up over 55 cents. And also, even though the call is further out of the money than the put, the delta is actually slightly negative here. Why? Because we see the IV explode to 250, right? And again, it's mostly due to that call, trading at about a 280 IV. And as we said, when you see this uptick in IV, we've talked about it before on previous newsletters, right? You see those deltas change just based on a function of an increase in implied volatility, especially on lower priced stocks such as UUUU, which is trading, around $20. That huge increase in IV at huge levels, right, makes the upward drift even more important. It kind of pushes the call delta up because the put delta is bounded by 0 to the downside. And if you want to take a look at a similar one here on our covered call, you can see with the stock at 22.58, right, we saw the delta on the call at 53 with the IV at 138.23. Then we saw a few days later the stock actually drop in price, right? And we see the delta on the call actually increase. Why? Because we saw this huge jump in IV. So the call delta on the covered call actually increased with the stock dropping well over a buck. So again, just highlights how increases in IV will also, at least short term, affect the deltas on the trades, and certainly affects the theta on the trade because it drives the price of the options up, which means there's more time decay. The higher the price of the option, the more it has to decay, right, as the option nears expiration. So it is a benefit, certainly, to option selling strategies. Like we talked about in our Strangle here, you can see that, the theta on the options now, as we took a look on Friday, 19 on the put side, right? You can see the theta on the call 26. So you're looking at 45 cents theta, right? Simply because of that huge jump in IV. Before, you're basically looking at theta 10 cents on either side. So massive increase in time decay. And that's a huge benefit when selling the straddles or strangles like we're talking about here. So another benefit of using implied volatility to structure the trades. And finally, we can take a look, a little bit longer one, goes out with earnings, kind of not close to it, but earnings do come out. And that's why we kept definitely somewhat bullish on this trade. So took a look at the NOV 25 straddle, right, selling the call and the put. So took a look from October 22nd, the stock at 2063. That NOV 25 straddle, selling the put and the call both, right? You could have gotten about $8.22. You would have been net long, right? Put definitely in the money, right? You're selling in the money put. That's a big bullish trade. Stock at 2063. So this is, $4.50 almost in the money, right? The call, similar amount out of the money. So definitely a bullish trade. The IV 142 at the time. Fast forward to Friday, right? We see the stock creeping up a little bit to 2137. Ideally, you want the stock near the strike price. If you're selling a straddle, right, you want it near 25. So you think this be a benefit of the trade, right? If you sold the straddle, you think it would get cheaper, right? But lo and behold, it got much more expensive, now at $10.35, right? As you see, the put's basically trading at $7, right? The call's trading at 340-ish. Before you saw the puts, right, trading under $7, right? Even though the stock rallied, the puts got more expensive. The calls were trading at $2. Now they're trading at $1.30 higher, even though the stock only went up about 70 cents, right? So the reason we saw this huge jump in IV, especially on the call side, right? So that sets up ideally for those who want to go a little bit longer term out there, selling that NOV 25 straddle for over $10, right? So your break evens on this simplistically, right, are 15 to the downside, right? 35 to the upside. The stock is at 2137, right? And you basically have a month to go or so, 27 days. And note too that the delta on the trade is officially negative, right? Simply because the call delta is at 50, the put delta at 48, even though the put is in the money by over 3.5 points now, the call out of the money by the same amount. The delta is actually flipped because of that huge jump in implied volatility. Again, forces the upward drift on these lower price stocks and makes the deltas increase dramatically on the calls. So certainly more than several ways to attack this. You can lean bullishly with that call buying by doing a covered call trade right out in December, where you're able to buy the stock cheaper, sell the call more expensive, which always makes sense to me. The short-term October 31st put spread, which got more expensive even with the stock heading higher, so you can lean bullishly in a defined risk way. The October iron Condor, right, only a week to go, basically capturing vol on both sides, plenty of cushion here, getting a bigger return for those who like to do just the straight out strangle trades, right, selling the 20 put, 25 call, getting a much bigger price for that as well, with a shorter time, right? So you've had days pass, right? The stock go to a more ideal place, but yet the Strangle got more expensive because all that big, unusual option activity drove IV to the roof. And again, we can just take a look. All we're looking really to do, sell the rip and then look to buy the dip when it comes back down to earth, and then going out to November and selling the straddle, right, which the puts are still deeply in the money, the calls out of the money, but the straddle price increased by over $2 simply because of that huge jump in IV and that upward drift. So hopefully provide some insight how we go about looking to take unusual option activity that has this big jump in IV and structure trades that have a probabilistic edge. But like we always say, trading is about probability, not certainty. So make sure you position size accordingly. So until next time, as always, here's the good trading. Take care.